Hey everyone, I'm Amy, and I'm here to explore this landscape with you as we unravel it piece by piece.
And I'm Tom. I'm here to help connect the dots, maybe provide some essential context, and hopefully uncover the deeper implications behind all those headlines. Today, we've taken a pretty close look at a set of sources from Exante Daily Insights, specifically their market review dated July 7, 2025.
Right. And our mission for you today is really to unpack the recent financial market movements, those persistent geopolitical tensions, and of course, the critical policy decisions that are shaping the global economic landscape right now. We want to move beyond just the numbers, help you understand the key forces at play, maybe give you that aha moment, and basically a clear shortcut to being exceptionally well informed. Okay, so let's maybe start by pulling back the curtain. Where did the major markets stand as we closed out last week? Starting with the U.S. stock indices.
Sure. So the S&P 500, it managed a solid gain. It was up 1.72% for the week. And the NASDAQ 100 also climbed about 1.48%. Both of them actually settled at record highs.
Record highs, okay. But it's worth noting U.S. markets were closed last Friday, right? July 4th.
That's right, yeah, Independence Day. So that rally happened over a shorter week.
And what about across the Atlantic, Europe?
European stock indices saw, well, more modest moves, but still positive on Friday itself. You had the CAC 40 in France up just plus 0.21%. Germany's DAX gained plus 0.61%. And London's FTSE 100 closed plus 0.55% higher.
So kind of a generally positive picture, but maybe not quite the same surge as in the U.S.
Exactly. These broad strokes paint a picture of, let's say, general market optimism. But as we'll dig into, it's definitely layered with some deeper anxieties underneath.
Okay. And meanwhile, U.S. Treasury yields. They showed a slight upward trend last week.
Yeah, the 10-year yield rose 6.6 basis points, ended up at 4.351%.
Yeah.
Again, like the stock markets, the U.S. bond markets were also closed on Friday.
Right. And speaking of assets that often tell a story about, investor sentiment,
hmm
what happened with gold, that's always an interesting one.
Gold is fascinating right now. It actually
Right.
saw a weekly decline, down negative 1.19%, settled at $3,332.99 an ounce. But it did rebound slightly on Friday itself, up plus 0.20%.
Okay, so a weekly dip.
Yes, but here's where it gets really interesting. Despite that weekly dip, gold was still up, wait for it, plus 26.70% year-to-date by Friday's close.
Wow, 26%. That's huge.
It really is.
Yeah.
And it isn't just a number, right? It suggests that even with these short-term market jitters, maybe investors are positioning for something deeper, perhaps anticipating, continued inflation or maybe geopolitical volatility that keeps that safe haven demand really quite elevated for the longer haul.
That resilience in gold is striking, especially when you put it next to the broader market hitting record highs. It feels like a contradiction almost. What about currencies? How are they reflecting or maybe influencing this underlying sentiment?
Well, the euro, it rose plus 0.50% last week against the dollar, reached 1.1778 a C. The U.S. dollar, on the other hand, it experienced its second consecutive week of depreciation. It's been weakening.
Okay, and a weaker dollar matters because.
Because it makes dollar-denominated assets, like gold, for instance, more affordable for people holding other currencies. So that could potentially explain some of gold's sustained appeal, you see.
Got it. Makes sense.
Sterling, the British pound, it registered a weekly loss, but it's actually still near a four-year high against the dollar. And it was up a pretty healthy plus 9.07% year-to-date.
Still strong then, overall.
Yeah. And the Japanese yen also showed some strengthening against the dollar last week.
Okay, so if we look at these market snapshots, the record highs, the yield shifts, gold's really strong long-term run despite a dip, and this weakening dollar, how do these numbers connect back to that fog of war theme our sources mentioned for June?
That's a really good question. Because the market's resilience, despite these anxieties bubbling underneath, it really does echo that whole fog of war idea. The volatility we've seen recently, it isn't just random market noise. It seems directly driven by these headline risks.
With trade tensions?
Exactly. Persistent trade tensions, escalating U.S.-Iran geopolitical friction. Investors aren't necessarily pricing in clear long-term fundamentals as much as they seem to be navigating by feel, reacting day to day. And that U.S.-Iran point in particular that directly impacts energy markets, which then creates ripple effects across currencies, broader economic outlooks. It just adds this layer of deep uncertainty the market's trying to digest.
Right. And speaking of those headline risks and navigating by feel, one specific storm seems to be brewing very quickly. A critical deadline is almost here: tariffs. President Trump's July 9th deadline. That's just days away, isn't it? Threatening pretty extensive tariff on countries that haven't secured new trade agreements with the U.S.
It's incredibly close. And this isn't just some abstract future threat either. Treasury Secretary Scott Bessent, he's already warned that the tariffs announced back in April, they're set to revert to those higher April 2nd levels on August 1st for countries without deals.
So soon, August 1st.
Very soon. And President Trump is apparently expected to send letters out, maybe even today, Monday, July 7th, detailing exactly what those new tariff levels will be. It's a very public, very high-stakes negotiation playing out.
And the EU in particular seems to be in a really challenging position here. EU Commission President von der Leyen, she openly admitted to the Financial Times that a comprehensive trade deal, well, it's just impossible within this tight 90-day window.
Yeah, and especially given the sheer size of the trade relationship, we're talking 1.5 trillion. It's massive. So Brussels is now pushing for something different, a kind of UK-style framework agreement, they're calling it. Similar perhaps to deals they've struck with Vietnam and Britain, which saw, reduced tariffs, 20% and 10% respectively in those cases.
So they're trying to find a middle ground, maybe?
It looks like it. And this trade dance, it's not just about tariffs on paper, is it? It's about the deep structural shifts they could force on global supply chains, on economic relationships. We're hearing EU diplomats are reportedly willing to accept maybe a 10% across-the-board tariff, but they also want reductions on current sectoral levies. Things like the really hefty 50% tariff on steel and 25% on auto parts.
And what do economists think might happen? What are the potential outcomes?
Well, they anticipate a range of possibilities. A sort of limited deal that just preserves current tariffs. That might still lead to a noticeable decline in the EU's GDP. On the other hand, a comprehensive, lasting deal with substantial exemptions could mitigate that impact quite significantly.
And the worst case?
A complete collapse of negotiations. That would result in a much more significant GDP decrease for the EU. And even that limited accord scenario, it could see major industries rethinking where they source materials or where they manufacture. That impacts long-term investment decisions, potentially shifts economic power. It's not just a GDP percentage point we're talking about. These policies have very real, very tangible impacts.
It really makes you think about the scale of modern trade talks. It's not just about goods anymore, is it? It's these incredibly integrated global supply chains. Okay, let's shift gears slightly. Moving from trade to broader geopolitical friction, let's zoom in on commodity markets, particularly oil. Oil prices fell on Friday, I saw. Why was that?
Well, part of it was the market looking ahead to the OPEC Plus meeting that was coming up over the weekend. That always causes some jitters. But there was also a specific report from the U.S. news website Axios. It indicated Washington intended to resume nuclear talks with Tehran this week.
Ah, okay. Talks with Iran.
Exactly. And adding to that, Iran's Foreign Minister Abbas Araqi affirmed Tehran's commitment to the Nuclear Non-Proliferation Treaty. So maybe a slight easing of tensions perceived there, pushing prices down a bit.
And then over the weekend, we got the big OPEC Plus decision itself. What happened there?
Right. On Saturday, they agreed to increase oil production by a pretty substantial 548,000 barrels per day for August.
548,000. That sounds like quite a jump compared to recent months.
It is. It's an accelerated increase.
Yeah.
It's contributed by 8 members, including the big players, Saudi Arabia and Russia. They started unwinding those big 2.2 million barrels per day cuts back in April, remember?
I do, yes.
So this August increase brings the total release since April to nearly 1.92 million barrels per day. There's only about 280,000 barrels per day left from that original cut package.
Okay. So they're putting quite a lot back onto the market. Any other changes?
Yes, the UAE was also granted permission to increase its own output by 300,000 barrels per day.
And what's the justification? Why the bigger increase now?
Well, the official line from OPEC Plus cited a stable global economic outlook and, quote, robust market fundamentals, including low oil inventories.
But is that the whole story? Sometimes there's more going on with OPEC Plus, Golo.
That's what you have to wonder. Our sources also suggest this acceleration was partly prompted because some members, like Kazakhstan and Iraq, were apparently already producing above their agreed targets.
Ah, okay. So maybe some internal pressure.
Potentially, it might have been causing some dissatisfaction among other members who were sticking to the cuts. So while the official reason is stability, there could also be an internal political dimension here. Keeping the group cohesive, maybe preempting market tightness from other geopolitical risks down the line.
Interesting. And their next meeting is soon?
August 3rd. So we won't have long to wait for the next chapter.
And just when you think it couldn't get more complex, there's another layer to this geopolitical story involving tariffs again. On Sunday, President Trump threatened another 10% tariff, this time aimed at the BRICS bloc.
That's right. An additional 10% tariff on any country supporting what he called the anti-American policies of the BRICS bloc. And that bloc, remember, includes Brazil, Russia, China, India, South Africa, and now, importantly, Iran. Iran just became a member on June 13th.
And this threat came after the BRICS nations met.
Yes, exactly. It followed their weekend meeting where they condemned U.S. and Israeli actions against Iran and called for troop withdrawal from Gaza. It really does highlight how interconnected all these different threads are.
It absolutely does.
And if we connect this to the bigger picture, it just becomes clearer and clearer that geopolitics aren't just influencing, they're actively shaping global supply and demand, and maybe even the future of international finance.
How so on the finance front?
Well, remember, Trump had previously threatened massive 100% levies on BRICS countries if they abandoned the U.S. dollar in their bilateral trade. And what has that done? It spurred interest within those nations in developing their own local payment systems, other instruments to facilitate trade and investment among themselves, essentially de-dollarizing parts of their commerce.
So these aren't just isolated spats, they are potentially driving fundamental shifts.
Deeply intertwined, yes. Influencing everything from the price of a barrel of oil, as we discussed, to the very structure of international currency dynamics. That fog of war we mentioned earlier. It's not just military, it's economic and financial too.
Okay, let's pivot slightly then to the fixed income markets. Bonds. What are central banks signaling amidst all this uncertainty? Eurozone bond yields, I read, saw their biggest weekly decline in a month on Friday.
They did, yeah. As investors sort of braced for that uncertainty around the U.S. tariff deadline we were just talking about, we saw movements in Germany's 10-year bond yield, for instance. It settled slightly higher on the day, Friday, but still recorded a weekly decline overall.
And in the UK, things seemed a bit more volatile there.
Yes, in the UK, the 10-year gilt yield actually surged earlier in the week. This was linked to renewed worries about fiscal sustainability. Our sources specifically highlighted this was partly triggered by the UK Chancellor's, well, visibly emotional appearance in Parliament. It was regarding a reversal of planned government cuts to welfare spending.
So domestic politics directly impacting bond yields.
Absolutely. That kind of uncertainty clearly impacts market perceptions of stability. It just adds another layer of complexity for investors to grapple with. It's easy to get lost in these abstract numbers like basis points, but when you think about how these bond movements directly impact things like mortgage rates or the cost of a business loan, suddenly these political decisions become very tangible for everyone.
That's a really important point. Okay, and looking at the European Central Bank at the ECB, what's the latest from them?
Well, their big annual forum was held in Sintra, Portugal. And the signals coming out of that strongly indicated a potential pause to their rate-cutting cycle later this month.
A pause. After quite a bit of easing recently.
Exactly. They eased by 200 basis points, that's 2%, over just more than a year. So a pause would be significant. Right now, futures markets are pricing in only a pretty small probability of another cut in July, maybe anticipating just one more cut by the end of the year.
So caution seems to be the watchword from the ECB.
Definitely. What really stands out here is that clear caution from central banks. Despite all that previous easing, they're signaling, let's wait and see, which directly impacts investor expectations for future borrowing costs or overall economic stability. And you combine that caution with the fiscal and political uncertainties we're seeing in places like the UK. It just adds yet another layer of complexity to the whole market picture.
It really feels like every decision, every statement from policymakers is being watched incredibly closely right now.
It is. They're all navigating this really unpredictable terrain.
So wrapping this up then, what does this all mean for you, our listener, as you try to make sense of your own financial world? We've covered quite a bit. A snapshot of markets hitting record highs, but with anxieties underneath. This high-stakes dance around tariffs with deadlines looming, and how these big geopolitical shifts involving Iran and the BRICS nations are directly impacting global oil supplies and international trade relations.
I think it just underscores how incredibly interconnected our world is, doesn't it? The decisions made in Washington or Brussels or within OPEC, plus, even, Chancellor's emotional appearance in Parliament. They all have these ripple effects. They shape currency values, commodity prices, economic outlooks right across continents. This really is that fog of war playing out in real time across global markets.
Okay, so for your final provocative thought today, consider how these seemingly isolated events, maybe a presidential tweet, an oil output agreement we discussed, or just a hint from a central bank how they can ripple through the entire global financial system, how they shape everything from the price you pay for gas each day to the cost of imported goods you buy. Understanding these connections and why staying informed. Well, it seems more crucial than ever right now. Thank you for your attention. You can subscribe to our podcast if you like it.
See you next time.